But if you pair stablecoin with stablecoin, you don't have to do anything tricky. You just do stable swap.
We know, Michael, we know that you had the largest loan on chain known to mankind.
Why is that the case, that the price over is the square root of the real Bitcoin price?
Yeah, that would be quite an interesting story. So
Welcome back to The Roll Up, your home for technical talks and open conversations that shape the modular future. Nothing on today's show is to be construed as financial advice. You can see our full disclosures list at therollup.co/ventures. Sit back, relax, and enjoy today's episode after a quick word from some of our awesome partners. The intersection of AI and crypto is moving fast, and soon an agent will be managing your on-chain transactions for you. But without guardrails, it's a disaster waiting to happen. Newton locks agents to your intent with cryptographic proofs and real penalties if they slip. Learn more at Magic Newton on X. What's going on, guys? Welcome back to The Roll-Up. Today, we have an episode about the DeFi Bitcoin black hole with our friend Michael here, the OG founder of Curve, one of the projects which I'm sure you guys have heard of. I know Robbie and I were messing around on chain in 2020. Curve is known for stablecoin swaps, some of the best liquidity on the market today for Ethereum DeFi. We have Michael in the building. Good to have you, Michael, and thanks for coming on.
yeah, hi everyone.
Michael, I guess one thing that struck me right when I learned about Curve and I learned why it was differentiated for stablecoins was the idea that you could essentially change the X times Y equals K model that we had all came to know and love in Uniswap V2. And I think you really set the foundation for, the rest of the decentralized exchanges to move to a concentrated liquidity model. Could you kind of talk about what in your mind led you to that innovation, and
Hmm.
ultimately how did you come to execute on that and figure out, okay, this is the right idea?
Right. Well, I mean, it started from thinking about what we know today as liquid staking, right? And I was actually doing New Cipher at that time, and New Cipher tokens, well, they were stakeable. And I thought, well, okay, what if someone wants to leave staking quickly? And of course, this also relates to Ethereum staking. And I thought that maybe something like concentrated liquidity is needed. But at the same time, I was kind of um, well, a big user of MakerDAO. Well, not big by the size, but I used it fairly often because I didn't want to sell my ETH. So I borrowed against ETH, borrowed DAI, and exchanged to USDC and withdrew that on Coinbase to my bank account.
Oh,
And
we know, Michael, we know that you had the largest loan on chain known to mankind that
all
the
right, well,
whole
but that
crypto
was
Twitter
not
was tracking.
that was
That
not on
that wasn't
MakerDAO.
on MakerDAO.
No, no. My loans on MakerDAO were relatively small, but the biggest bottleneck was that liquidity for DAI was not very good at all, and there was even off-chain, and there was no particular reason for that. So I thought, well, what if the algorithm which I'm thinking of for liquid staking, because liquid staking was not the thing yet, why not don't I apply it to DAI and solve my own issue here? I've well, I wrote a simulator. It looks like it would work okay. I estimated the market size. Market size looked okay. Well, it actually proved to be exactly the market size which Curve captured eventually. And um, I started implementing that in maybe September 2019, and by January 2020, everything was fully ready for launch, including the UI. So, and I launched it. So that's essentially how it happened. It appeared that already with 500,000 liquidity, which the pool got in maybe a week, it outperformed all the existing exchanges essentially. I think the probably the best at the time for this particular purpose was some internal order book based exchange of running by MakerDAO, I think. And well, obviously order books on Coinbase. So the $500,000 pool outperformed all of those. And users came from using 1inch. 1inch at the time was extremely fast in integrating anything. They integrated it in like half a day. So even before their smart contract code was verified, it was already integrated and it was amazing. And yeah, so that's how it started.
Yeah. So before we get too deep into kind of where we're going with yield basis and some of the technical DeFi concepts, which I'd love to touch on, I'd like to just kind of explain to the audience some of the lore here. So we joined kind of doing this podcast and whatnot in like early 2020. Rob and I found DeFi in late 2019. You know, we were some of the first yield farmers on Compound, on Yearn, and these places, and of course Curve, and you know we're active in it, and just vividly remember the first Curve interface feeling like a 2000s Dell computer vibe, and this kind of initial evolution of DeFi was what really brought in a lot of the brains and minds that are in the space still today, like Michael, like ourselves, where it really truly felt like a 0 to 1 moment in terms of new capabilities on chain. And so that kind of played out through 2020, 2021. 2022 came, a lot of the yields compressed, and you know, kind of DeFi went through its like kind of growing up moments where a lot of what was built was kind of exposed for basically the lack of sustainability, core foundational problems such as impermanent loss, causing LPs to have a lot of permanent losses, which I'm sure we'll touch on, and much more. So the part of the lore that I want to ask you about, though, Michael, is what I found to be quite funny, which was all of crypto Twitter was watching your liquidation price on your Curve loan. Uh, and this was going around in circles. You were getting memed for having a mansion. They were trying to liquidate you and pump Curve and dump Curve and do all these things. So maybe you could just walk us through your thinking of that position, and just kind of like what happened in that like couple week time period.
Right.
I think the audience would appreciate the
Well, I don't know
lore
if
here.
I can really. Well, I don't really like talking about that too much, I would say. But I think in brief, I would say this that I don't like to sell crypto, especially crypto of the project which I created, right? So I really don't like that. And this is exactly why I used MakerDAO, and that's because I didn't want to sell ETH, but selling CRV is also something I really did not plan to do at all. And this is why this uh, essentially loan was created. But yeah, it was, I would say, not so easy avoid to avoid liquidation, and um, it's um, how to say, the value of the token can quite significantly deviate from what you can say the fair value should be. So you probably, if you hold any crypto, you can quite say that the true market value can be deviating from the real value by factor of 10 in either direction, right? So
I think they call that. They say that the market can stay irrational longer than we can stay solvent.
right. So I think this is exactly that. And really, the way to do it properly is probably not by I don't know, not by selling, not by borrowing, but by building something which is I would say sustainable. Well, Curve obviously is sustainable, right? But the real sustainable yield, which can be earned not for just LPs, but also for the system, and eventually benefit everyone, should be coming from somewhere, from the activity which is happening on the platform. On Curve, well, what's activity happening on Curve today? It's obviously stable swap, swapping between currencies of the same denomination mostly, and Curve stablecoin, which is, well, minting, which is borrowing this stablecoin. So, and well, I would say that it's, well, stable swaps at least. They have some limits of how big this market is, and they reached that limit many times already. Like, so stable swap reached its limit. So definitely we need to go somewhere beyond.
Yep.
And well, somewhere beyond, I guess, should be some different source of revenue, which I think should be volatile swaps. But yeah, solving the problem of volatile swaps without having impermanent laws was always an issue.
It always has been. I mean, I remember LPing for the first couple times thinking that it was going to be easy yield. And over time, you kind of learned that it was a much more actively managed strategy than you thought it was going to have to be due to the, price discrepancy between two different assets. Now, just one more thing on the lore, and then let's talk about yield basis. Did you ever have any interactions with like on Andre Cronje when you were building Curve, and like did you guys build anything together there? And
Right. Oh,
and
yeah,
then
that's a yeah,
yeah,
that would be quite an interesting story. So I think Andres started interacting with me in late January 2020. He immediately recognized the potential. At the time, he was building this, well, not Yorn, but I earn, so with letter I. And the essence of the project was essentially, um, well, um, kind of um, yield aggregator for lending platforms. That's what it really was. It was tokenized as a sort of vault, and basically he told me, well, my even the first Curve pool was using compound tokens, so compound deposits as stable coins, so why not use his thing? And I said, yes, this is a great idea, so let's just do it. And on, well, in the beginning of February, we launched a pool which used his Vault tokens, essentially, a Y pool. And, well, mm, I think something was before the Y pool. I think first it was USDT pool, and then Y pool, something like that. Anyway, one of the first pools, and it worked pretty well. Um, Later, he thought, well, we thought of something even crazier. So he contributed a code for the first SUSD pool, and that was crazy because it was, um, how to say, first meta pool. Well, I figured out how to do meta pool and explained it to Andres, so he uh, plugged in. He plugged in the existing pool, and it was swapping between SUSD and LP token of Y pool, and everything was kind of assembled together in that pool. Well, unfortunately, that pool is dead by now because a month after I figured that there was a vulnerability, so we asked. So Andrea made a small mistake, and we asked all the LPs to migrate to a new plain pool, SUSD pool, which is still up today. And another thing with that pool was that because it was using a pool which swaps between yield aggregator tokens, it was using essentially 2 million gas for every swap, so which appeared to be pretty painful as Ethereum gas prices started growing up. Um, So, but anyway, the idea of meta pools was implemented later in a more proper way and worked fairly well over the years.
If I know Andre, he is not happy that his mistake is being exposed.
Well, I mean, it didn't lead to any losses, and I mean, yeah, it was a kind of a wild time. So, but
Absolutely. I mean, this is DeFi composability at its finest, right? We have
right,
Yearn operating as intended, and we have Curve also in parallel operating. And the two founders, Michael and Andre, get together and say, "Hey, wouldn't it be great if we composed our two products together
yeah.
and we were able
That
we were able to harmonize the yields?"
was a great example of composability, and later farming of Y pool to get YFI worked really really well.
Yeah, yeah. One last thing on the lore here as well is I remember quite vividly in the days leading up to the UST collapse, the UST, USDC, USDT uh, Curve 3 pool, which is like this meta pool idea that you guys introduced and then started introducing these three pools. You could slowly see the ratio start to get filled up much more with UST versus USDT and USDC. And this was like the leading indicator for something fishy was about to happen. What was going on in your mind at that point? And
Yeah.
yeah.
Well, it was definitely a feeling of increased risk. So I was, I would say, I was initially very uncomfortable with UST, even when everyone was super excited about it, and I was deeply uncomfortable about it because it was a stablecoin collateralized by its own protocol token. So it felt not not correct to me that to do that really, so too dangerous. And I did talk to Doc One, and at some point, well, there was also llama risk assessment of UST, and it did look risky really. So what Doc One proposed to do is to do something which was called LFG, um, so some reserve where it's not protocol token which collateralizes UST, but Ethereum and Bitcoin essentially. And I mean, it looked kind of better to me at that point. So I thought, okay, maybe if they diversify collateral towards that, maybe it will be better. Uh, well, it appeared that well, later, much later, I found that it's not necessarily they used LFG to support the peg as they should have. And really, it was probably too small of a reserve, which is not reliant on the protocol token. And another thing, you probably still can make a stable coin backed by its own protocol token if this protocol does something else than the mere stable coin with yield. For Terra, it was kind of that. There was Mirror protocol, which allows to swap uh, between kind of synthetic versions of real assets, but activity from that was much smaller than the yield they've been giving away. So really, it was kind of a stablecoin backed by its protocol token, where the whole task of the protocol is to, I don't know, to print yield, right? So
Yep. Interesting times.
This is the snake eating its own tail. You can just
yeah. So it's you really need some externalities here, and it's not necessarily even the tokens which are externalities. It would be I don't know, activity which is given the value to collateral should be mostly not your stable coin.
Yeah. So I'm curious how this kind of relates to the Curve tokenomics and the Curve protocol as a whole, because one thing that took DeFi summer and turned it from farming sushi coins and yam coins and food coins with 1,000% APYs and made it something that felt more real, that was the Curve wars. And that was like this ecosystem around Curve with Convex and Vote Escrow and like all of this very exotic and very interesting behavior that was happening as you say, the externality to the protocol itself. So could you describe why it's important to have the surrounding ecosystem that is
Mm.
outside of the protocol itself? How does that help bolster the value and make a project more sustainable?
Yeah. Well, that was not something I thought about initially. I mostly thought about something a little different. I thought about aligning protocol participants with the long-term success of the protocol. That's why I introduced voting escrow thing, where you get governance power and power to earn, uh, proportional to not just your token amount, but also to the lock time. And that that appeared to have not really only governance consequences, but also economic consequences. It appeared to be a much better supply sink than I don't know, buy and burn model, for example. Um, but also something I did not expect. I did not expect people selling votes. That was not planned. And this was again first introduced as a sort of bribing platform, launched as a um, simple smart contract by Andre Cronje. And by the way, it had a bug, as it appears. But anyway, it was not a critical bug. Um, but yeah. Anyway, so um,
You guys are so funny, man. You guys are so funny.
yeah. Well, I mean, it's you don't deposit funds there, right? So bugs cannot be critical there. But it all the information which allows you to compute what the incentives to what are the incentives to distribute, all that information is already on chain. Historic balances of VECRV are recorded on chain and accessible from any smart contract, which makes it very convenient to write these platforms which measure who voted for what and for how long and whatever. So that allowed to create so-called bribes, and they were integrated with all the secondary platforms. Like we had Convex appearing, and YEarn didn't really play in the bribes game, but Stake DAO. So I think that was something which gave apparently extra value to VECRV.
Yep. Okay, so we've had lots of several years that the Curve project, Curve DAO, has been around, it survived. There's been lots of learnings that you've taken from Curve, and now you have a new project. It's in stealth, but part of this podcast is bringing this out of stealth. Yield
Right.
basis.
Yep.
So let's talk about yield basis. Let's talk about
Mm.
what it is, how it works, and we'll talk about the learnings that you learned from Curve and how you applied those to yield basis. But
Right.
first,
Right.
let's start with the basics. What is yield basis?
Right. So basically, it's a project where I try to solve impermanent loss. And well, what I mean by that, so well, if you deposit something in any flavor of volatile swap, be it on Curve, be it on Uniswap 2 or 3 or 4, you always have the same problem. The problem is if you deposit essentially two currencies there, I don't know, Bitcoin and USD, and price of wrapped BTC goes up, or maybe it goes down, doesn't matter. The value or in your pool appears to be almost always smaller than the value of these coins if they don't do anything. So you could just put them on a shelf and they collect dust, but actually they would be more expensive than your the value of your pool if the price of your crypto is significantly different from where you started. Of course, you earn some fees on top of that, but they usually don't close this gap, and that's kind of an issue. I would say this is really well. the fees produced in volatile swaps are really large. I think they are much larger than the fees produced in stablecoin swaps. But this impermanent loss issue really prevented people from keeping liquidity in there. So it's just well, imagine that you deposit funds in a crypto swap because it showed 100% APR or whatever, and you held funds there, and then you figured out that you have actually less than deposited, and then you hear that this is not a loss because it's impermanent, and it's you just didn't lose anything, you just have less money, that's all. It kind of sounds wrong, and yeah, so that's why TVL in I don't know, in Uniswap, for example, is not necessarily super huge, especially if you look at like democratized liquidity not coming from any large players. And that kind of that problem, well, I mean, I know that it's impermanent loss is not actually a loss. It's not something you lose to someone. It's just a mathematical property of the of liquidity in these sorts of pools. But for user, it doesn't matter. Like, it's if you withdraw less money than you deposited, it's a loss, right? So anyway, I figured how to actually get rid of this um, uh, like mathematical artifact, so to say, and have it interfaced um, as like staked Bitcoin, for example, or maybe staked Ethereum if it's for Ether. Why not? So that's so user basically deposits crypto and has yield bearing crypto, and that's it, right? So sounds very easy for a user to understand, and all this management is abstracted away inside the algorithm itself. But I mean, it's easy for user, but not easy how to create this algorithm. So I figured that it actually builds very well on top of Curve crypto swap, which by the way existed since 2021. Well, it just needs few modifications, but most of the logic should live outside of the crypto swap. And I thought that maybe it's a great opportunity to make also a new token where I would apply all the learnings I've got from observing CRV, and maybe to do a few modifications there.
Yeah. Okay. So maybe we can talk about where this new protocol design works the best in, and where it might struggle to earn yield, and kind
Right.
of like how exactly those dynamics
Yep.
affect the protocol design. I'd like to talk about that a bit, and then we can get into kind of some of the token design as well.
Yep. Yeah. Well, I mean, it probably makes sense for me to mention how approximately it works and where impermanent loss at all comes from. So, as I said, it's built on top of Curve crypto pools, which do have a little bit of concentrated liquidity, which is automatically managed. And it was working like that since 2021. So, I would say if you optimize it for APR, it would probably be higher APR than XYK pools, but just a little bit higher, not like orders of magnitude higher. And Curve crypto pools by themselves would have had exactly the same impermanent loss as Uniswap 2. So this is impermanent loss we are trying to get rid of. And well, this is impermanent loss is just a property of rebalancing strategy, right? So if you have any kind of rebalanced portfolio, you will have that problem. So it's just inherent to that. And basically, another way to look at it is this: if you deposit something in Curve crypto swap or Uniswap 2, let's say in WBTC USDT pool, for example, if you deposit funds over there, then your liquidity will have base price not equal to Bitcoin price, but equal to square root of Bitcoin price. right? So you
Could
have this
could you break
annoying.
that down? Could you break that down for people? Like why is that the case that the price over is the square root of the real
Well,
Bitcoin price?
it's just a mathematical property of how this rebalancing strategy works. So, well, how to say? Imagine that you have, I don't know, 100k worth of USD and 100k worth of BTC, and let's say BTC went up by, I don't know, 2%, right? And then it appeared that you have 2% more BTC than USD, but the pool, it actually should strive to make itself balanced. So it kind of sells to traders 1% of BTC, and then you have 101k worth of USD, 101k worth of BTC, right? But if you are doing that all the time, then it appears that later, if it's not changed by 1%, but changed by 10% or 100%, you're, well, the as you start having less BTC, it appears that price of all the portfolio is not like not equal to sum of prices of these assets, but it's actually a little bit smaller. And to be precisely, yeah, it appears to be the price of LP appears to be proportional to square root of Bitcoin price. So and this is a really annoying dependency. So that because square root appears to be always smaller than a straight line which goes through some point on this graph. So anyway, um, and so thinking was this: what if I try to construct some position which inverts this square root dependency? So to invert square root, I need to do what? I need to do something which squares it. So if you have square root squared, you have Bitcoin price back. And what sort of position should that be? It appears that this position is leverage, but this leverage should be not typical leverage, like where if thing is going up, then you actually having less leverage. If thing is going down, you liquidated. That's not the leverage which we want. The leverage which you want is leverage where you keep the leverage constant. So if, I don't know, Bitcoin goes down and your liquidity price goes down, then you decrease the loan size and sell a little bit of liquidity to do that. Then your leverage will be always constant. And this is the thing which apparently inverts the square root dependency. So which does the square, which you apply to square root. So it's a leverage token on liquidity token. And that's what appears to get rid of this impermanent loss. But it appears that it's not as simple, because if you get rid of impermanent loss, you actually realize some permanent loss, which if you applied that to XYK pools like in Uniswap 2, it appears that these losses would eat away entirely all your profits, which you would have made. But with curve pools, it appears to be not like that. With crypto pools, you actually do have quite a bit of profit left on the table after you do that. And this is what yield basis kind of is feeding on.
Got it. Okay, so in the instance that Bitcoin becomes more and more of a stable asset, would that be a beneficial outcome for yield basis versus extended
It's a
periods of
good,
volatility?
yeah, that's a good question. So it should be somewhat volatile, but its volatility should be not crazy. So what it appears, if well, this method works well if concentrated liquidity works well for the asset, and concentrated liquidity works well apparently when asset has some volatility, but tends to return back to some trend line. Major crypto assets do seem to return to the trend line. So it's not entirely random walks. It's they are kind of gravitating to some trend line of the asset price. So if they fluctuate around this trend line but return to it, then they are good assets. So Bitcoin appears to be a very good asset for that. Ethereum seems to be okay. Major other tokens probably seem to be workable as well. Meme coins don't appear to be okay. If something works as crazy as meme coins, it's too volatile. Concentrated liquidity doesn't seem to work well. So the yield you probably wouldn't be able to make, I don't know, um, to make a staked meme coin, unless it's unless it's a kind of well established long living staked meme coin, right? So anyway, staked meme coins are probably not possible, but staked Bitcoin, staked Ether, I don't know, something with, I don't know, BNB or whatever, that works. That should work fairly well, I think.
And how about something like stable coins that do have a very flat trend line? They tend to always return to that trend line. They don't have too much volatility, but they tend to oscillate around that stable.
Yeah, which stable coins do you mean?
Yeah, well, not UST and some of the recent ones, right? But USDC, USDT,
Right.
some of the more
Well,
more common pairs.
yeah. But if you pair stablecoin with stablecoin, you don't have to do anything tricky. You just do stable swap because the trend line is just constant. Or maybe if you have yield varying token, like I don't know, SUSD from Athena, then the trend line is also having a, well, it's going up only. You don't have to do anything tricky. You do that on a curve already, so it's like nothing special you need to do. And by the way, it's not like the really huge yield in those swaps, but there is some, of course. It, but anyway, maybe more interesting would be, can you do it with foreign pairs, or can you do it with gold, right? And with that one is a much more tricky question, because it appears that maybe if you take euro dollar pair, it's all the profit is pretty much taken away by traders. So its price is very, very close to its trend line at all the times, and euro dollar pair probably doesn't really have too much of a profit sitting in it. Maybe if euro stablecoins start getting accepted on chain and there is some volatility above the international markets, then it probably would work. Otherwise, euro is probably not the best one. So staked euro, I don't really know. But also maybe maybe for these very stable assets, you don't really have to make it a yield basis way. You can still have a pool which still has some impermanent loss, but prices of your assets don't change too much, so maybe this impermanent loss will be really small. Staked gold would be probably more interesting. I didn't really simulate that, but maybe it's possible to have staked gold. I don't know.
Ladies, gentlemen, Anons, and Degens, it is stablecoin season, brought to you by your favorite, the best in stablecoins, Frax. USD dollar stablecoin backed by the best in the business, the Biddle Fund by BlackRock and Superstate. This is stablecoin season. It is the yield-bearing stablecoin by Frax, coming soon to a chain near you. One thing that I think our audience really, appreciates about our podcast is that, we try to ask questions that help extract like the edge in each of
Right.
these protocols.
Mm.
Um, it's not something that, oh, if a token is volatile, right, then this makes it great. Or if it's not volatile, it doesn't make it great. And one thing about the Uniswap V2 and even Curve to a certain extent was, look, it's actively, you just put it in, it's
Yep.
passive, right?
Right.
And yeah, you experience some impermanent loss, but it's easy. So if you're
Right.
looking at yield basis and you're thinking, okay, what is the best way to play this game to get the most edge and use the protocol to its fullest capabilities? How would you suggest users use yield basis?
Well, I think there are two ways. It's very simple from the user perspective. You either earn real yield, so you deposit, I don't know, crypto, some sort of a Bitcoin wrapper, and then you earn yield on that. So you have you get more bitcoins over time. That's one way. But there is another way. Because there is a protocol token, you can earn protocol token. So what I wanted to make it easier for users, I'm just splitting between users who want to earn protocol token and users who want to earn real yield. So if you want to deposit Bitcoin and earn just more Bitcoins over time, you just deposit and that's it. You don't do anything. If you want to earn governance token, you explicitly choose to not earn real yield. So you can earn either one or the other. I think the market will equalize both, so you will probably have a similar APR, and it's really if you want to hold this token and if you want to earn it, you probably deposit this way, right?
Got it.
And yeah, you have both options when depositing.
So you can choose the denomination of your yield, and this is
Yes,
quite a bit different from
yes,
Curve because you didn't
that's
give
different from
users the
Curve.
option
Yeah,
anymore.
and different from just traditional yield farming, right? Where it was all just
That's right.
pool one. The whales would get into pool one, then they would farm the pool two effectively, and then the pool two
Right.
had zero value theoretically over time, and it was basically a race to see who could get the most size in to pool ones to be able to basically
Right.
unload on the pool twos.
Right.
So
Right.
your new token design is
Mm.
basically is a result of this reality effectively.
Yeah. So, well, it's just making it's kind of the same in terms of numbers eventually, but if you have a traditional design with pool 2, you kind of have to have everyone go into to pool 2, otherwise they are missing out. Here it doesn't matter if you go to pool 2 or not, you are not missing out, right? So maybe there will be some discrepancy between APR. So maybe some APR will be 1% more or whatever, but it's not heaps, right? So maybe some traders will kind of exploit this discrepancy and bring the APRs closer together by doing that. But really, the idea is that users who don't want this complexity of why should I stake, and or like, oh, I forgot to stake, so I didn't earn any yield for several months. This did happen in the past, and really, probably better to not have that. So probably better to have users earning regardless, and if they want to earn real yield, they just earn real yield, and then they have this yield bearing crypto, and this yield bearing crypto would be integratable with all the lending platforms, for example. Probably much easier for them to integrate, because like if there is something which farms governance token, integrating that with Avi would be harder, right? And so probably much easier to have something in the token itself, and then all sorts of looping plays appear over there, but this would be external to the protocol, but also kind of spreading integrations around, which is good. So so yeah, in
Okay.
brief, it would be easier for users and more integration friendly.
Okay, so then what was the exact breakthrough around the token model then that supports yield basis? It's around the optionality for the users with regards to their yield as we explained.
I think yes. I think that's probably the well. I mean, the biggest breakthrough here is not in the token model, obviously, but in the token model, I do want to do something new, and this is exactly that. It's splitting between users who want to earn real yield and users who want to earn tokens. And um, I think another thing to explain here. Imagine that. Imagine a situation if everyone wants to earn tokens and no one wants to earn a real yield, right? That's theoretically possible. Where would real yield go in this case? So it should go somewhere, but nobody wants it. Where does it go? In this case, it would go all to the system, to those people who locked YB token. So actually, admin fee of the system, it actually grows up as people stake as people try to earn governance token. And if 100% of people try to earn governance tokens, then 100% of yields go to admin fees for the system. But of course, if there is, well, the market will find some equilibrium. So there will be some split between people who want to earn governance token and people who want to earn real yield. So there will be, well, some admin fee, which probably will depend on the state of the market.
Got it. Okay, so that my next question was, where does the yield come from? I think this is one of the more fundamental questions, and it seems that you answered this. It comes from the admin fee. Could you just, and maybe there's some other fees. Could you explain just a little bit more in detail what is the
Yep, yep.
admin fee, and is there
Right,
any other fees that
right. So
produce yield?
admin fee is fee on top of the profit which the system is making. So imagine that you deposited 1 WBTC, right? And 1 WBTC turned into 1.1 WBTCs, right? And admin fee will be a fraction of this 0.1 WBTC increase.
Okay.
Got it.
Right, but since we have only those people who want real yield, having real yield, right? So we take this 0.1 WBTC, and this goes not to all the 1 WBTC, but maybe half of WBTC sits earning YB token, and half sits earning WBTC. So this 0.1 WBTC goes to this half of WBTC, not to the whole one of WBTC. That kind of stuff.
And where does the 0.1 WBTC come from?
This comes essentially from the actual source of it is exchange fees in Curve CryptoSwap pool.
Okay.
Right.
Okay.
The thing is that this pool spends a whole bunch of these fees on rebalances, right? And also yield basis will experience some value decrease, like real value decrease due to re-leverage, keeping the leverage constant, and what is left will actually be the profit.
So the more swaps in and out of WBTC on the crypto swap pool on Curve will generate more fees, and
In a
theoretically,
way, yes, but also volatility of WBTC will generate losses, right? Because you keep the leverage constant, and there is this this difference between profits and losses which you are making.
Right.
right. So usually more volatility in the pool creates more swaps as the pool rebalances. But you're
That's
saying
right. That's
it
Yeah.
right.
balances out with the leverage rebalancing.
Yeah. But also, I would say that more volatility at the same time means more losses, right? More losses on keeping the leverage constant, on rebalances of the concentrated liquidity.
Right.
So
Right.
and the trick is to have this balance positive, not negative.
Mm.
Right. So, as I was alluding to earlier, effectively, I suppose the longer term thesis for yield basis is is based on the idea that Bitcoin has gone through a logarithmic growth curve esque phase, right? With the majority of the day to day volatility behind us, still one of the most volatile assets when you're looking at it from a traditional portfolio perspective. But the thought is for users, if you believe that BTC is a core holding that you want to have, which I think all of crypto has has gone through a whole cycle of like loving Bitcoin, then not wanting Bitcoin, then usually coming back to Bitcoin. Um, if you think that this kind of logarithmic growth curve is basically coming to a more narrow chart formation where there's going to be less volatility on both the upside and downside, then yield basis is a product to take that bet and earn outsized yield as a result of holding Bitcoin itself.
Well,
And
you kind of have it interfaced as yield bearing Bitcoin. So
yeah,
you yield basis itself doesn't make any assumption, but users make an assumption that they want to hold Bitcoin.
wait, but doesn't the protocol design make the assumption that this will work better in if Bitcoin becomes less volatile, like in those economic models that
Yeah,
we were working
it's.
through?
I would say that it's more like a safety assumption which is
Okay.
made.
Okay.
And safety assumption is that over time, cycle to cycle, Bitcoin will probably be less volatile, and which when algorithm is optimized, uh, when algorithm is optimized, then we kind of assume that volatility will be not higher than the highest volatility over the data which we used for optimization. And the data which we used is data over, let's say, last cycle, right? So if
Got
in
it.
this cycle Bitcoin volatility will be smaller than in the last cycle, then we are totally safe, and value of holdings will in Bitcoin terms will never go down, right?
Yes.
And which is not the case if Bitcoin becomes more volatile than in the past cycle. So then you could lose, like, I don't know, 5%, for example, if Bitcoin becomes more volatile than it ever was over the last cycle.
And
I,
just to clarify that, when you say lose 5%, hypothetically, you're not saying that the number of Bitcoin, if I have one Bitcoin, I still have one Bitcoin. It's just that the value of my Bitcoin might
No, no,
drop.
no. It's I mean, it's value in bitcoins actually. So let's say
Okay.
if everything works normally, like if volatility is not higher than what you observed, then you have 1 Bitcoin, 1.1 Bitcoin, 1.2 Bitcoin, so on. But let's say if volatility of Bitcoin becomes higher than what you ever observed, then maybe it suddenly becomes from 1.2 Bitcoins to like 1.15 Bitcoins, and then continues growing after that when volatility is calmed down. So I tried to simulate that around different times where volatility was high, like, I don't know, FTX collapse, for example. It was more affecting Ethereum than Bitcoin, by the way. But yeah, it's something where you can you can induce a value loss by deliberately tweaking parameters to be too aggressive. So when you make parameters more aggressive, they actually work better at low volatility times, but at high volatility times they can have a kind of rollback of value, not unlike what you have regularly in I don't know, hyper liquid vaults. But I think that's not a good model. We probably don't want to have rollbacks of value ever. Even if the total APR is higher with rollbacks, it's probably better to not have rollbacks. And this is all kind of um, driven by how the pool is optimized, and all depends on volatility and on liquidity concentration. So basically, the less the volatility is, the higher liquidity concentration you can afford, right? And if you have something like a meme coin, then liquidity concentration just doesn't work. It just doesn't work with concentrated liquidity. So for meme coins, the best is to have just simple XYK pools.
Got it. Okay. So in the model, then when we're thinking about applying capital to earn yield in this model, especially with the new token design, um, are we thinking about a specific strategy or ecosystem around this yield basis
Well,
product?
I think our some ecosystem around will definitely grow,
Okay.
but to actually earn yield, you don't really have to use the ecosystem, right? You can do it directly. But maybe what would be really great is integrations with all sorts of lending platforms. For example, you well, I can imagine that looping strategies will be very interesting.
Mm, okay. Got it. And I know this may be kind of a difficult question to answer with regards to the yields, but do you have any expectations or forecasting as to what to expect from the different yields on this product in comparison to other Bitcoin yield type products?
Yeah, it's a really difficult question because, hard to predict. But at least based on the past data, I would say that in bear markets, like let's say when the bear market is at the bottom of it, you maybe will have a little bit sub 10%. I don't know, 9% or something, right? If you look at the peak of the bull market, let's say if you take the APR over average APR over year 2021, it would have been 60% APR, so really large. If you take, let's say, the start of the bear market, 2022, um, it shows around 20% APR in that time because volatility was reasonably high, but actually volatility around the bull market and crash after the peak is still higher. So over there you have higher APR than in the start of the bear market, and beginning of the bull market is also kind of probably higher than 10%. So right now we have quite increased volatility thanks to all sorts of news, positive and negative. They shake Bitcoin in both directions, but it's all good. It's all good stuff. I probably would expect something higher than 10% APR here.
Cool.
Maybe 20%, but it's a guess, right?
Yeah.
I probably should look in practice, even not necessarily just simulations.
Got it. Michael, really appreciate you coming on. I do have one more question, and it
Yes.
kind of points to these shakes. We're going back and forth market, but
Yep.
also like, the sentiment kind of gets shaked left and right.
Yep.
For someone who's been around since 2019 and built multiple projects that have succeeded and sustained through multiple years and multiple cycles, what kind of advice would you have for someone that is, maybe a little bit jaded, maybe just getting a little disillusioned with the whole crypto thing? It's maybe not really what they thought it would be when they got into it. What kind of advice would you give to someone that is kind of feeling this way, to just kind of, you know, like, what has kept you going over these years?
Mm. Well, I think the ideas of crypto seemed very right by design, and also I used crypto fairly often, and over time I use it even more often. And over the last year, it's not easy to find a day when I did not use crypto. I mean, crypto to interact with real world, not to just earn, not to yield farm or whatever. So it seems like it's, well, also the world is kind of more divided today than it used to be. And when the world is more divided, it's well, traditional finance is a little bit less connected, and crypto doesn't care. Crypto just moves around, and it's the only global thing which is left, and you cannot really make it less global. So I think the situation in the world is such that crypto is becoming more and more useful. Maybe uh, maybe some people use crypto only because they used it for the sake of going up, right? But really, the true purpose of crypto is not just is not an investment vehicle. It's useful beyond that, and this is exactly what makes it more and more valuable. So I think all crypto is which is fundamentally useful, like any deeply good fundamentals is something to stick to.
Agreed. Last thing on my end is what is the timeline here to getting yield bases out into the wild?
Right. Well, I think we are around final stages of audits of the core of yield basis. It will take a little bit more time, but not too long to get the token stuff out. And after that, it can be fully launched. Before it fully launched, though, I probably will run some little test in prod instance where I want to look at yield being real yield being earned in production before actually spinning the system to be too big via the token, because you don't really want uh, to scale something before you try to optimize it. And yeah, so I just wanted to optimize it a little bit, not just in calculations, but also to check in production again that yes, indeed it coincides with calculations. So this is something we want to scale.
Amazing. Thank you, Michael, for joining us today. It's been an awesome conversation. Looking forward to seeing yield bases out there in the
Perfect.
near future.
Excellent.
Thank you, Michael.